Well, the next candlestick pattern I want to explain to you, dear ones, is the Harami pattern. In literal terms, Harami means thief, bandit, and highwayman, and generally Harami patterns are divided into two categories: bullish and bearish patterns. However, bullish Harami patterns themselves are divided into two categories. As you can see, we have two types of patterns: the bullish Harami pattern, which includes the bullish Harami and the bullish Harami cross. Let's see what the schematic representation of these candlestick patterns looks like and what signals they give us. Well, as you can see, the Harami pattern is one of those patterns that consists of two candlesticks next to each other. This means, but now, it might include 2 days of stock activity, where the events of those 2 days create two candlesticks that form the relevant Harami pattern. And then we need to extract the corresponding signal from it. The bullish Harami pattern is a formation. Pay attention, dear viewers. The first candlestick is so large that the second candlestick, with its entire schematic representation, including its low price and high price, fits within the body of the first candlestick. And when this happens, the first candlestick, which is larger, has a solid body. Let's take a look at this together right here. Let's review what a solid candlestick means. A solid candlestick is one where the closing price is at the bottom and the opening price is at the top. This means its close is lower than its open. The stock closes that day, but the next day we have a hollow candlestick. What does hollow mean, guys? It means the close is at the bottom and the open is at the top. I'll write this down so you can see it better. All right, look here, dear ones. We actually have the close here. And here we have the open price. And in this area, we have the close. But conversely, for the lower candle, our close is at the bottom. And our open is in this area. So what happens here? When your first candlestick is filled and your second candlestick is hollow, and the second candlestick is so small that its entire schematic representation fits within the first candlestick, we call this arrangement a bullish Harami pattern. In a bullish Harami pattern, if you encounter this arrangement, the signal it gives you is that in the following days, the stock had good days at a lower level, and gradually the stock is expected to enter an upward trend. This signal is a bullish Harami pattern, but the bullish Harami cross is exactly like the bullish Harami, with the difference that the second candle is a doji. So the difference with the bullish Harami cross is that your second candle is a doji. And what does a doji mean? Dear friends, it means that my open price is equal to my close price. When the open and close are equal, you have a doji, but the schematic representation is still exactly like the bullish Harami pattern. This means your doji must be completely within the body of the first candle. And the first candle must definitely be a filled candle. What does a filled candle mean? A filled candle means exactly like the candle we have. This means our close is at the bottom and our open is at the top. Well, here when I encounter a bullish Harami cross pattern, it actually gives me the same signal again. This means that after that, the market is supposed to enter an upward and positive trend, and something good is expected to happen to the market with a higher probability. The difference between a bullish Harami and a bullish Harami cross is that acceleration or intensity, meaning greater intensity. In fact, here we will witness a more intense growth in the stock's price chart. All right, let's move on to the other two categories of Harami patterns, namely bearish Harami and bearish Harami cross. Well, a bearish Harami pattern occurs when your first candlestick is a completely large one and the second candlestick is a small one that forms entirely within the body of the first candlestick. The difference between this pattern And the bullish Harami is that in a bearish Harami, your first candlestick is a hollow one, and the second candlestick can be a filled one. When this happens, it means that the market is likely to experience a negative trend for the stock. In other words, your prediction is that the stock will decline in the coming days. However, the bearish Harami cross is exactly like the bullish Harami cross, where your second candlestick is a doji, but with the difference that the first candlestick is a hollow one. Unlike the bullish Harami cross, in the bearish Harami cross pattern, your second candlestick is a doji. The first candlestick is a large and completely hollow one, and the second candlestick is entirely within the schematic representation of the first candlestick. If you encounter a bearish Harami cross pattern, know that the market will not have an upward trend for the stock, and it is likely that this stock will gradually decline with a higher probability of this decline occurring. This means that the difference compared to the bearish Harami is that the likelihood and intensity of the decline will be greater. Well, that concludes the explanation about Harami patterns. And let's move on to another pattern.